be shaky for the beginning part.
It's all right.
Uh-oh.
Blame all the on me.
Sorry, you guys. We are live. Yeah, it's going to be shaky for the first part.
So when you tag it, yes. Yes.
I don't know where you... There. Okay, guys, we're back with tax tips with Right Way Tax and Financial Services. I am Kemisha Hall, and we have Tamisha Wells as well with Task Realty Group, the Real Estate Chicks, and the beautiful Anika. Say hi. We will be going in right after this song. I hope you guys are getting a lot of information from us. If you have any questions or concerns regarding your personal tax returns, feel free to inbox us. And we'll definitely get you in touch with her, as well as if you have questions right now for the listeners, feel free to post your comments in the comments section, or feel free to text me at 832-907-2247 or Tamisha Wells
at 713-825-9139.
Right now, we'll go in approximately 1 minute or so feel free to start shooting us those comments and questions. That's why I told you I couldn't see you. You moved.
Right there. You're good.
Don't quiet. Don't get timid.
Oh, no, we're good. We're actually about to go in right now.
There, somebody's sending me one through my phone. Let me see.
Obviously, you didn't. We're not.
Get another song?
Yeah, by mistake. So just talk to them about some of the things that we talked about, staying in the fees and predatory, staying away from that time.
Yeah, maybe it's like the
Mason,
recap.
Yep.
Yep.
They can hear me from that far?
Yeah, absolutely.
Gotcha. I'm new to that, so just checking that to make sure you guys can hear me. But for the most part, while we're kind of in a little intermission, is I really want to caution taxpayers with tax preparation. Tax preparation is a beautiful season. It's like Christmas in the New Year. Yeah. However, at the same time, it's a double-sided thing here. You have to really be mindful who you let do your taxes. Just because people can promise you X amount of dollars, it's not if, it's not when, and everything that glitter is not gold. So don't just look at the refund amount and what people can promise you to get you back. Like, it's so many people out here. I mean, if they call, they know what they're doing. Anybody, if I wanted to, you know what I'm saying, I could get you back X amount of thousands of dollars. But the problem is, it's not just about getting you back a certain amount of money. It's also about making sure you stay in the clear with the IRS. Y'all just seen this major bill, this tax reform that just got voted on. So you've been hearing it for years, you've been hearing it all your life. The IRS not playing, the IRS not playing. But you don't really understand it until you get them CP letters in the mail. And then you want to question, okay, why this and why that was done on my taxes. So be mindful, because when people are charging you, taking $1,000 out your refund checks as their preparation fee, it 9 out of 10, it's something to that. Read between the lines. You know how it is. So just be mindful of how much people are charging you. There are some very good tax offices out there, and they do charge a nice fee, couple $100, but their services is valued at that. Like, they are very competent and very knowledgeable of what they're doing. So for instance, when you come to our office and you might get hit with a $500 bill, I'm just giving you an example. I'm not saying per se for you. Just understand that you can be confident in what you're paying for. And if the IRS does send you some type of letter or notice or audit, because of course we can't, no matter how good we prepare a tax return, you still are prone to something to teach you know how your other tax years were prepared. So with that being said, we will be there from start to finish to walk you through it. I'm not gonna file your taxes in January. You get that letter in March or April or June if you get a letter, and then you can't call me anymore. A lot of tax offices come come April, the doors close, the windows go down, the lights get turned off, and you cannot call that tax preparer. You need a copy all year long because you want to do your student loan application. The IRS has sent you a letter. The tax preparer that prepared your taxes, they MIA. They know where to be found. So make sure that, yes, you might pay a pretty penny, but you're getting valuable services with
That's
that.
awesome. We're going in 10 seconds.
10 seconds. 10 seconds. They're gonna be back on live. So don't ask how much they get you back. Ask how much they charge.
This is The Real on Real Estate. Thank you guys for tuning in. We are here every Wednesday from 12 to 2. This is Tamisha Wells.
And Kemisha Hall, and this is the Real Estate Chicks. Thank you so much for tuning in for Tax Top Tips. We're just going to jump back in and start talking about real estate and tax concern, right?
Absolutely. Our guests, please introduce yourself again for those listeners who were not listening in the first portion of the show.
This is Akila Gillespie with Right Way Tax and Financial Services here in Houston, Texas, specializing in tax preparation for individuals and small businesses and bookkeeping.
Perfect. And we already gave Facebook listeners, because we are live listeners, we already told them a little brief synopsis of what was talked about earlier about, watching out for those predatory tax preparers and knowing what you are paying for. So let's jump back into it and talk about, can W-2 employees file too much tax deductions to qualify for their home?
Well, there are two types of deductions that people need to be mindful of. You have the standard deduction and you have the itemized deduction. A standard deduction, no. If you're taking the standard deduction, then no, it's standard. If you're taking itemized deductions, it's no maximum on itemized deductions except certain types, such as the 2106, which is unreimbursed employee expenses. And that's a type of deduction that people take if they are spending their own personal funds for their job. So if your job requires you to take the toll road to go between different locations throughout the day, and you have to personally pay for tolls or uniforms or special equipment that they require you to have that they're not reimbursing you for, then you can deduct those type of expenses. However, if you go in to buy a home, they will subtract those expenses from your income. So if you want to buy a home and you want to report, hey, you want to report as much money as possible, but you also showing that, hey, I made this amount of money on my job, but I spend a couple $100s to buy uniforms, supplies, and equipment, they will subtract that amount from your income. So make sure you stay away from the 2106s when you're trying to buy a home.
That is very, very important.
I know we talked about offline that you normally have an intake with your clients to find out what are their goals for the next year. So what can you tell us? What do you tell them if they're looking for a home? What to be prepared for?
I tell them taxes plays such a huge. People understand how much taxes plays a part in getting approved for your home loan. Everyone thinks I have a good job, I make good money. All I gotta do is provide them copies of my W-2s and my check stubs, and great, they'll be able to corroborate that I made enough money to qualify for my home. However, with tax preparation, it really plays a part because the IRS and home loan lenders want to be able to corroborate the information that you're giving them. So I tell them to be very mindful, one of their itemized deductions, to be mindful of their business income and expenses. A lot of people, they work W-2 jobs, but they also do something on the side. They might have a car wash. They might do something that they're generating some additional income for that they want to include to be able to qualify for their home loan. Well, with that additional income, of course, it comes with additional taxes. So a lot of people tend to try to write off the expenses for that income. And when you're trying to buy a home, you can't have your cake and ice cream. It's advisable to report the income, but be very careful with those expenses, because they will subtract all those expenses from your income, and you won't be able to count on that income to qualify for your home loan.
Yeah, there's some clients that didn't understand how taxes work when purchasing a house. So I have a client who makes $90,000 a year. However, he also has a side business. And so that side business, all the expenses, it brought him all the way down to $43,000.
Exactly.
So that it really hurts you. It definitely hurts you.
Right, and I know sometimes the clients say, well, during income tax time, I'm going to get $10,000. What they don't understand is that there's closing costs, then there's down payment. Your down payment alone may cost you $7,000. And sometimes our W-2, our self-employed clients think, well, I have the money to back me. But if your tax return don't show that you really have those funds, unfortunately, we cannot count it. As for when I say we, I mean the lender cannot count those funds if it's not accurately shown to IRS.
Exactly.
Very true. Very, very true. So how about the tax returns that affect individuals? So we already talked about that, but now what about the self-employed individuals? Not with the W-2s, but the self-employed individuals. All of their income is based off of the deposits, basically. Yes. So is it the same for individuals that are W-2 and have a side job and individuals that's self-employed only? Is there any difference in between
when you're trying to purchase a home?
Yes.
So when you're trying to purchase a home, someone that has both W-2 income and self-employed income, you're in a little bit of a better position as far as trying to corroborate all that type of income, because if you're working on a W-2 type of job, of course they're taking taxes out of that income.
Right.
Whereas when you're working self-employed on the side, it's no taxes coming out of income. Sometimes the taxes from your W-2 job will help offset the taxes owed on the self-employment income. So if you're trying to buy a home and you have two types of income, you can really you're a little bit more flexible with people. You don't have a huge tax liability as someone who is 100% self-employed. If you're 100% self-employed, you don't have any type of taxes coming out. And if you haven't set up to be paying quarterly taxes, then yeah, you're going to report 100% of that income and you're going to owe 100% of the taxes off of it. And that's what kind of deters a lot of people from report. Everybody wants to put all their expenses on there so they won't have to pay the tax liability. But when you're trying to buy a home, you cannot have your cake and ice cream. You cannot not report all your income and not pay any taxes and at the same time get the dream house you want. You're going to have to choose. I'm going to have to take an IRS hit, liability-wise. I might owe the IRS, but I do have my dream home. And then next year you continue on the practice and do what you normally been doing in the past. But with taxes and self-employment income, you cannot have your cake and your ice cream and expect to get the dream home you want and not pay the IRS anything.
And we need you to pay for 2 years consecutive.
2 years.
Sometimes if you want different grants, they may look at your 3 years of taxes, but normally it's a practice of 2 years. Can you give us examples, now that they're first-time home buyers, a lot of times they don't know their tax breaks. Do you have 3 examples of a tax break for first-time home buyers, i.e. homestead exemption is one of them? Can you give us some more examples?
Well, the main thing is a lot of first-time home buyers, you excited about getting your home and your first year buying a house, you automatically assume, oh, I'm going to get a huge tax break. It also depends on when you bought that home.
Right.
That plays a part into it as well. If you bought your home at the end of the year, 9 times out of 10, you won't have put enough into it to be able to claim some of the itemized deductions that go along with buying a home, such as the mortgage interest deduction. So usually the first year you might not get to take advantage of that. Now if you bought your home early in the year, yeah, you can take advantage of the mortgage interest deduction. You can also take advantage of the property tax deduction. You can also take advantage of the interest paid at closing. So a lot of times at the end of the year, your mortgage company will send you, a first-time home buyer, at the beginning of the new year, you'll get a 1098 mortgage interest statement, and it'll tell you how much money you've paid in interest. You can take that amount of money, and you can write it off as a deduction on your taxes. A lot of people assume, oh, that means I paid $5,000 worth of interest. No, that does not mean you're going to get $5,000 back on your income tax. No. What it does is that $5,000 will help lower your taxable income. So it'll help you owe less money or get more money back in terms of a refund. So the main thing is when you're doing the mortgage interest thing and they send it to you, sometimes the mortgage company forgets to include any interest you may have paid at closing. If it's not on there, you can by all means go ahead and add it yourself. Give it to your tax paper like, hey, this form only says 10, but here this closing statement and settlement statement, it says I paid 2. Add that on with it. So, and another main tax break is The property tax, we just mentioned that with the homestead exempt, you can deduct what you pay towards property taxes. And you can also do an energy saver tax credit that they have for homeowners. Whereas if you have made energy efficient repairs to your home, meaning you made something that's environmentally safe, you put an environmentally safe refrigerator or some type of appliance, you can get a tax credit for doing that as well.
Perfect. Thank you so much for that information. We definitely want to move over to the sellers. So let's jump on in and ask about the sellers. No? Okay. Well, there's a form out there now. Some of my clients actually use it when they're selling a home. And do we want to ask anything else about buyers before we move on? Okay. And there's a form called a 1031 exchange. No?
We can talk a little bit about that, yeah.
Okay, great. Okay. Well, I know one of my clients, they wanted to use that form. However, they were not prepared to use it because they didn't sign up for it in time, etc. when they were selling their home. That document, I'm sure you know all about it, but it
tell us a little bit about what is the 1031 exchange.
Mainly, as far as it depends on, mainly it's used for people who are like real estate investors, or say most of the time if you have a personal residence and you sell your personal residence and you get some type of gain, meaning you bought it for $100, you sold it for $200, so technically that's $100,000 gain that you gained on your personal residence. But the key word is personal residence. So a personal residence up to $250,000, you do not have to report that as any type of gain. So if you sell your personal residence, no, you don't have to add the money, the gain, as income to your tax return. 1031 exchanges mainly work in favor of people who they're buying and selling non-personal residences. So for instance, I have some rental properties. If I sell one and I made $100,000 gain, but at the same time I turned around and I just bought another property with a certain time frame, then technically I don't have to recognize that
lot. It has
to be either same or so I want to use the correct word. They need to be of equal value.
Compatible.
They need to be of compatible value. So mainly for most individual people who are selling their personal residences, you really don't have to too much worry about that. That mainly is for people who are selling their non-personal residences.
Okay. Well, that's actually good to know because I know that the client did not or was not aware of that.
Gotcha.
So that's good.
As a owner of a home, what type of repairs can I write off on my taxes? Now I've gotten my home, I can write off everything that I want to write. I don't have to file all these tax deductions. So what can some of the things that they can think about writing off?
It's different type of repairs. You have repairs related to casualty losses, such as with Hurricane Harvey, and you have regular repairs. Regular repairs that increase the value of your home. Mm-hmm. Meaning if the AC goes out and you have to go pay someone to fix AC, that is not something that's tax deductible.
Gotcha.
Now, if you go and you do a new state-of-the-art, energy efficient AC that has just added value to your home, meaning I just increased the value of my home, it's now worth XYZ because I added this specific item. Then technically those things are not necessarily tax deductible. They're what you call capitalized, meaning they add the value to your home. So when you get ready to sell your home, originally market value might be $100,000, but you added about $50,000 worth of upgrades. So that makes it a little bit more. You've added more value to your home. But as far as adding up all your receipts for all your home repairs that you did, I did air conditioner, had to put a new ceiling fan, had to do all this. No, you're not going to be able to write those type of repairs off on your tax returns. Now, energy efficient appliances, yes, you can get a tax credit for it, but it's not like a deduction that goes against it.
So you did mention the repairs that many people are doing because of Harvey. So let's talk about that a little bit. How does that affect individuals and their tax returns?
Well, any repairs, and that one is a very intensive subject, but I will say this in a nutshell. Whatever money that you spent, it's going to be offset by however much money you received. So your house might have had $100,000 worth of repairs, yes, but if Harvey cut you an $80,000 check, and the insurance cuts you a certain amount of check, then no, you wouldn't be able to claim all those things for casualty losses and things like that because you did in turn get reimbursed for those things. Now, anything above and beyond what you were reimbursed for, yes, those can be considered. However, they have a lot of income phase out. Certain people who make a certain amount of money, and I hate to say it because just because you make a lot of money doesn't mean you should be penalized. A loss is a loss. You lost your home.
Right.
And you shouldn't be penalized for the fact that you make over a certain amount of money. However, if you are a high income person, then you won't be able to benefit as much from this huge Harvey thing. So a lot of people think, oh, I had a Harvey, I'm going to get all this money back. I'm going to just be honest with you. It's not going to be as wild as what people think it's going to be. So
Definitely. Is there a limit on property tax deductions that one person can claim?
yes, it's a limit. Well, it's like a phase out,
Okay.
meaning after your income, and I think it's about $300,000. Once you get above $300,000 mark, you can't deduct the whole amount. It's a percentage of it.
Okay.
So it's not a limit. It's a phase out. Meaning right now, if you're under $300,000 a year, then you can deduct. If you pay $20,000 in property taxes, you can actually itemize that off. Whereas if your income is over a certain amount, you will only be able to do a percentage of that $20,000 to deduct. But as your income gets higher, you really lose a lot of these property tax deduction benefits. But for the individual taxpayer, the more middle class consumers and taxpayers and homeowners, most of the people will be able to deduct the full amount of whatever property taxes they paid.
Now, I know we talked about it a little bit earlier as far as the homestead exemption and filing. You can only do that, get a deduction if they close earlier in the year. As realtors, we get buyer agents calling us or listing agents saying that we must close by the 31st so my client can get this credit or these deductions. But you stated that if it closes before the end of the year, like say for instance December the 29th, that's the closing date, they won't get that much credit back, or can you?
Meaning, I was speaking in regards to the mortgage interest deduction.
Just the interest.
Meaning,
okay.
you get to deduct the amount of interest that you pay.
Okay.
Itemized deductions work like this. You can choose to either take the standard deduction or itemized deduction when you're doing taxes.
Okay.
The standard deduction is a standard deduction that the IRS automatically gives you, just like I call it the cost of living. The only way to itemize is if your itemized deductions equal up to more than the standard. So for instance, you're married filing joint, it's like $12,200 for the standard deduction. You can either take the $12,200 standard deduction that the IRS is giving you, or you can say, oh no, all my stuff add up to, well look, I paid $12,000 alone in property tax, in mortgage interest. And then plus you add my property taxes to it, I paid $6,000 on that. So I got about $16,000 worth of deduction. I'm not taking your $12,200. I'm gonna take my $16,000.
Right.
What happens is if they close later in the year, they haven't made as many monthly payments.
Right.
So they might only they just bought a house in December. Well, they only made one payment. So their one payment and they property taxes, they're prorated too at closing. So they might not have enough, depending on their filing status, to add up to more than the $12,200 if they're married that the IRS is giving them. Now next year when they have 12 full months of payments, and if they got a high interest rate or whatever, they might have more than $12,000 worth of interest or deductions that they paid into.
Thank you so much for that clarity for myself and the listeners. Just sometimes we just don't get it, and you're in this world. We want to understand the breakdown of it.
Absolutely. So there is so much that we can talk about taxes, and we do appreciate you being here on the show. And we're about to wrap up in the next 15 minutes, but we definitely want to talk about the charitable organizations that you are with, or things that you do to help the community and things like that. And also we talk about the good, bad, and the ugly when we get closer to the end of the show. But go ahead and tell our listeners any more additional tips that you would like to tell them about their taxes.
Well, I do want to tell the listeners, and I'm just going to hit on this real briefly. Taxpayers, do not fear. I know there's a lot of going on in the news and Congress about the tax reform, and it's going to affect everybody, whether you are a low-income taxpayer to whether you got deep pockets. We're all going to feel the effects of it. But I want to let everybody know, do not be fearful. Do not be cautious of it. Make sure you don't just believe the hype and you get on social media. There's so many things out here. Research it yourself. Look it up and then, formulate an opinion about it. I can say this. It's not going to have our cake and ice cream. It's not going to be 100% perfect reform for everybody. But there is something in there for everybody, every income bracket. And I will say this on a long-term note, regardless of the fact, tax is all about planning. It's all about planning. I don't care if you make $12,000 a year, or if you make $1.2 million a year, you need to plan. Plan for your tax refunds. Plan for if you owe money and how you're going to not owe as much money. Plan, plan, plan. So no matter what the legislature or whatever they vote on or whatever gets thrown your way as a taxpayer, you're ready for it. You are ready for it. A lot of people think tax planning is for wealthy taxpayers or high income taxpayers. No, you get a refund check every year. Plan for that. Plan for it. So that's my biggest tip to taxpayers is to plan. And get with a taxpayer who believes in planning. A lot of my clients, if you know me personally, they contact me all year round. I know 6 months in advance, man, I'm gonna buy a house with my income tax, or I'm gonna do this with my income tax, or I'm gonna pay off this with my income tax. That's great. Start planning early in the year for what you're gonna do with your income tax money and how it can benefit you all year long. Make your income tax money work for you all year long.
I know we didn't